Topic: Cost of capital. Subtopics: First, computation for source of finance. Second, weighted average cost of capital. Third, marginal cost of capital. What is cost of capital? Cost of capital is the opportunity cost of funds available to a company for investment in different projects. The most common measure of cost of capital is the weighted average cost of capital, which is a composite measure of marginal return required on all components of the company's capital, namely debt, preferred stock and common stock. Most companies are for-profit entities which must generate wealth for its shareholders and debt holders. The projects they invest in must earn enough to pay off the interest on bonds and other debt and pay cash dividends to shareholders and/or generate enough growth to cause an increase in their stock price. It is important for companies to calculate the cost of different components of capital, identify their target mix of debt and equity, and work out their weighted average cost of capital. In deciding whether to invest in a project or not through the capital budgeting process, they must compare the return available on the project with the cost of capital and accept the project only where the return is higher than the cost of capital. If they invest in projects with return lower than the cost of capital, they are effectively destroying their shareholders' wealth. What does the cost of capital tell you? Cost of capital represents a hurdle rate that a company must overcome before it can generate value, and it is used extensively in the capital budgeting process to determine whether a company should proceed with a project. The cost of capital concept is also widely used in economics and accounting. Another way to describe the cost of capital is the opportunity cost of making an investment in a business. Wise company management will only invest in initiatives and projects that will provide returns that exceed the cost of their capital. Cost of capital, from the perspective of an investor, is the return expected by whoever is providing the capital for a business. In other words, it is an assessment of the risk of a company's equity. In doing this, an investor may look at the volatility, beta, of a company's financial results to determine whether a certain stock is too risky or would make a good investment. What is weighted average cost of capital, WACC? The weighted average cost of capital, WACC, is a calculation of a firm's cost of capital in which each category of capital is proportionately weighted. All sources of capital, including common stock, preferred stock, bonds, and any other long-term debt, are included in a WACC calculation. A firm's WACC increases as the beta and rate of return on equity increase because an increase in WACC denotes a decrease in valuation and an increase in risk. Learning from WACC. WACC is the average of the costs of these types of financing, each of which is weighted by its proportionate use in a given situation. By taking a weighted average in this way, we can determine how much interest a company owes for each dollar it finances. Debt and equity are the two components that constitute a company's capital funding. Lenders and equity holders will expect to receive certain returns on the funds or capital they have provided. Since the cost of capital is the return that equity owners or shareholders and debt holders will expect, WACC indicates the return that both kinds of stakeholders, equity owners and lenders, can expect to receive. Put another way, WACC is an investor's opportunity cost of taking on the risk of investing money in a company. A firm's WACC is the overall required return for a firm. Because of this, company directors will often use WACC internally in order to make decisions, like determining the economic feasibility of mergers and other expansionary opportunities. WACC is the discount rate that should be used for cash flows with a risk that is similar to that of the overall firm. To help understand WACC, try to think of a company as a pool of money. Money enters the pool from two separate sources, debt and equity. Proceeds earned through business operations are not considered a third source because, after a company pays off debt, the company retains any leftover money that is not returned to shareholders, in the form of dividends, on behalf of those shareholders. Who uses WACC? Securities analysts frequently use WACC when assessing the value of investments and when determining which ones to pursue. For example, in discounted cash flow analysis, one may apply WACC as the discount rate for future cash flows in order to derive a business's net present value. WACC may also be used as a hurdle rate against which companies and investors can gauge return on invested capital (ROIC) performance. WACC is also essential in order to perform economic value-added (EVA) calculations. Investors may often use WACC as an indicator of whether or not an investment is worth pursuing. Put simply, WACC is the minimum acceptable rate of return at which a company yields returns for its investors. To determine an investor's personal returns on an investment in a company, simply subtract the WACC from the company's returns percentage. Limitations of WACC. The WACC formula seems easier to calculate than it really is, because certain elements of the formula, like the cost of equity, are not consistent values. Various parties may report them differently for different reasons. As such, while WACC can often help lend valuable insight into a company, one should always use it along with other metrics when determining whether or not to invest in a company. Marginal cost of capital. Marginal cost of capital is the weighted average cost of the last dollar of new capital raised by a company. It is the composite rate of return required by shareholders and debt holders for financing new investments of the company. It is different from the average cost of capital, which is based on the cost of equity and debt already issued. The weighted average cost of capital, WACC. The most common measure of cost of capital used in capital budgeting and business valuation is the weighted average of the marginal cost of common stock, marginal cost of preferred stock, and marginal after-tax cost of debt. The distinction between average cost of capital and marginal cost of capital is important. The marginal cost of capital rises as the company raises more and more capital. This is because capital is scarce, just like any other factor of production, and must be compensated through a higher required return. The return available on new projects must be compared with the marginal cost of capital and not the average cost of capital, and the projects should be accepted only when the expected return is higher than the required return. Marginal cost of capital increases in steps and not linearly. This is because a company can finance a certain portion of new investments by reinvesting earnings and raising enough debt and/or preferred stock to maintain the target capital structure. The reinvestment of earnings comes without any increase in cost of equity. However, as soon as the expected capital exceeds the combined amount of retained earnings and debt and/or preferred stock raised to maintain the target capital structure, the marginal cost of capital increases.